Imagine finding a way to borrow money for, well, practically nothing, and then immediately taking that cash and putting it somewhere else, different country, different currency, where you get a much higher return. It sounds almost too good to be true, right? Like a financial cheat code?
Yeah, like a guaranteed win just by shuffling money around. That's the seductive idea behind the global carry trade. We're talking massive amounts of money, trillions, and when it moves, it can shake markets way beyond just currency pairs.
But, I mean, if it were really that simple, that risk-free, you'd think everyone would be doing it, and the profits would just disappear, vanish.
Exactly. And yet it persists. Our sources show it definitely persists, and researchers are still trying to pin down exactly why it seems to offer this premium over time.
Right. So this deep dive is all about, peeling back those layers in the carry trade. We really want to focus on what it means from an American perspective. How does the U.S. dollar fit in? Is it the cheap money you borrow, or is it the place you invest for that higher yield?
We've pulled together quite a stack of material here. We've got foundational stuff from places like Investopedia, explaining the basics, high-risk investments. Then there's market analysis from Saxo Bank specifically on FX carry trades. And what I find really fascinating is this detailed academic work from the National Bureau of Economic Research, the NBER, that really digs into the nitty-gritty of the risks and those big drawdowns.
So our mission today is to basically guide you through all this. We're going to pull out the key insights, maybe highlight some surprising facts, and try to reveal those crucial aha moments about this really high-stakes global game.
Yeah, cut through the jargon, get a clear picture.
The goal for you listening is to walk away with a solid, maybe more nuanced understanding of the carry trade, especially how the U.S. dollar plays into it. Let's unpack this.
Where should we start? The absolute basics.
Yeah, let's do that. At its core, what's the fundamental goal? What is the carry trade trying to do?
Okay, think of it like this. Fundamentally, you're trying to profit from the fact that interest rates aren't the same everywhere. Different countries, different rates. The basic mechanic is you borrow money in a currency where the interest rate is low. That's your funding currency.
Okay, cheap to borrow.
Right. Then you take that money, you convert it into another currency, one where interest rates are significantly higher, and then you invest those funds in asset bonds, maybe something else denominated in that higher interest rate currency. That's your target or investment currency.
Got it. So the main goal is just capturing that difference. The spread between the low rate you pay on the loan and the high rate you earn on the investment. That gap is the profit, the carry.
Precisely. That's the primary engine. Investopedia puts it nicely. They call it borrowing at a low interest rate and reinvesting in a currency or financial product with a higher rate of return. You're literally carrying that interest rate differential.
But you mentioned earlier there's potentially another layer to the profit, right? It's not just the interest rates.
Yeah. Yes. Good point. That's crucial. Beyond just collecting that interest rate difference, the carry trader is also hoping for something else. They hope that the investment currency, the one they bought, actually appreciates in value compared to the funding currency, the one they borrowed while the trade is open.
So a double win potentially. You get the interest and the currency moves in your favor.
Exactly. If that happens, when you eventually close the trade, sell your investment, convert the currency back to the one you borrowed to pay off the loan, you do it at a better exchange rate, it adds an extra layer of profit on top of the yield difference.
So using that classic example, borrow Japanese yen super cheap, invest in U.S. dollar assets, earning more. You pocket the rate difference and you hope the dollar strengthens against the yen, so when you buy back yen later, it costs you fewer dollars.
That's the ideal scenario, yes. And as we'll get into, that exchange rate movement, it can often be the biggest driver of the final profit or the biggest driver of the loss.
Right. Now, the concept sounds simple enough: borrow low, invest high. But the sources are clear. This isn't typically done by, physically moving suitcases of cash around for big players. How does it actually work in the markets?
You're absolutely right. It's much more sophisticated, especially for institutional money. Most carry trading isn't about swapping physical currency. It happens mainly through financial instruments, primarily in the foreign exchange markets, using things like currency futures or, very commonly, forward contracts.
Forwards. Those are agreements to swap currencies at a set rate on a future date, right? So you can kind of lock in the structure of the trade using those.
Exactly. You can set up the borrowing and investing legs using these forward contracts, and this is critical. The sources all emphasize that these trades often involve significant leverage.
Leverage. using borrowed money to control a bigger position.
Precisely. Traders use leverage to control a much larger amount of currency than their own capital would normally allow. Why? To magnify the potential profit from what might be relatively small interest rate differentials.
But leverage is always a double-edged sword, isn't it?
Always. It dramatically amplifies potential gains, but it equally amplifies potential losses if the trade goes south. It makes small movements, good or bad, look much, much bigger.
Okay, this actually brings up a theoretical point you sometimes hear about in finance, interest rate parity. What does that theory suggest about the carry trade? Should it even work?
Yes, interest rate parity, or IRP. It's a cornerstone theory. Basically, IRP suggests that the difference in interest rates between two countries should be perfectly offset by the difference between the spot exchange rate and the forward exchange rate. In theory, if you borrow low-rate currency A, convert to high-rate currency B, invest it, and simultaneously use a forward contract to lock in the rate at which you'll convert B back to A later. Any gain from the interest rate difference should be canceled out by the cost built into that forward rate.
So a perfectly efficient market, according to the theory, shouldn't allow for a risk for free profit just from borrowing low and lending high. The forward market should price it away.
That's the textbook theory, yes. The forward rate should adjust, so you're basically indifferent between investing at home or doing this carry trade using a hedge. However, and this is the fascinating part where theory meets reality, the sources make it crystal clear that traders often make their biggest profits not just from the interest differential itself. They profit from the fact that the actual way the exchange rate moves during the trade often deviates, sometimes significantly, from what the forward rates predicted it would do.
So the forward rates aren't perfect predictors of future spot rates.
Exactly. The source material explicitly says traders frequently profit most from discrepancies between actual exchange rate changes and those implied by forward rates exploiting inefficiencies where theoretically no profit should exist.
That gap, that deviation, is often called the forward bias, right? The fact that forward rates systematically seem to misprice future currency movements, at least on average over time.
Precisely. And the fact that this forward bias seems to persist, allowing carry trades to generate positive average returns, is one of the big puzzles in international finance. Why does it happen? Why isn't it arbitraged away completely?
It suggests maybe markets aren't perfectly efficient in pricing currency risk, or perhaps there's some other, maybe hidden risk that traders are taking on that the simple theory doesn't capture.
That's exactly the debate. It's likely a combination of factors.
Let's talk about the currencies themselves. The sources mention typical funding currencies and investment currencies. Where does the US dollar usually sit in this picture?
Okay, so funding currencies, the ones you borrow, are typically those from countries with persistently low interest rates. Makes them cheap to borrow, obviously. The classic examples mentioned over many years, as you'd expect, are the Japanese yen, JPY, and the Swiss franc, CHF.
Right, because Japan and Switzerland have often had near zero or even negative interest rates as part of their monetary policy.
Exactly. Now, on the other side, you have the target or investment currencies. These are usually associated with higher interest rates, offering a better return on investment. The sources list currencies like the Australian dollar, AUD, the New Zealand dollar, NZD. The commodity currencies often fit here. Also, sometimes emerging market currencies like the Brazilian real, BRL, Turkish lira, TRY, or the Mexican peso, MXN.
These often come with higher perceived growth, maybe, but also higher perceived risk.
That's often the trade-off, yes. But it's not just about the currencies themselves. The sources also point out that assets denominated in certain major currencies, including the US dollar, think U.S. Treasury bonds or U.S. stocks, can be the targets for carry trades funded elsewhere.
Okay, so that brings us right to the American perspective. For someone operating in U.S. dollars, the USD doesn't just play one role, does it? It can be on either side of the trade.
Absolutely not a fixed role. This is really key for listeners. The USD is incredibly flexible here. Its role depends entirely on where U.S. interest rates are relative to the rest of the world at any given time. If U.S. rates are relatively low compared to other major economies, the dollar can actually serve as a funding currency. You might borrow USD relatively cheaply and invest that in higher-yielding currencies or assets abroad.
Probably the most famous carry trade strategy of all time is the yen carry trade. And in that one, the dollar usually plays the opposite role, right?
Exactly. The yen carry trade is the textbook example where the USD acts as the target currency. For decades, investors have borrowed Japanese yen at incredibly low rates, converted that yen into US dollars, and then bought US dollar assets, treasuries, stocks, corporate bonds, anything offering a yield significantly higher than the near zero cost of borrowing yen.
So in that massive long-running trade, the US dollar is firmly on the receiving end, the investment currency.
Absolutely. It's been a huge flow into USD assets funded by cheap yen. And the academic research we looked at, the NBER paper, specifically drills down into this, looking at USD-centric carry trade strategies.
What do they look at specifically?
Well, they analyze strategies like one they call EQUSD. This involves taking equal-weighted positions in other major G10 currencies against the US dollar based on whether their interest rates are above or below the median G10 rate relative to the US rate. It's a way to isolate and measure the carry trade premium specifically from the perspective of the dollar's position in the global interest rate hierarchy. It treats the dollar as, a central reference point.
Okay, so we've got the basics. Borrow low, invest high. We know it's done using forwards and often leverage. We know the dollar can be on either side. But this brings us back to that core puzzle researchers grapple with. If the simple theory says it shouldn't really work consistently, and we know there are risks, why does the carry trade seem to offer this persistent positive average return, this risk premium over long stretches of time? Why hasn't competition eliminated it?
This is the central question, isn't it? It makes the carry trade such a hot topic in finance. Like you said, simple theory suggests any extra return should just be compensation for some clear, identifiable risk. Yet, study after study, looking at historical data, finds this premium that's really hard to fully explain using just standard economic models or the usual asset pricing factors. It seems to exist empirically, but the why is still debated.
The NBER paper digs into several possible explanations for this stubborn premium. What are some of the main theories floating around?
Okay, one is simply calling it risk premia, but the paper itself notes this is kind of just restating the puzzle, right?
Like saying it's risky, so it pays more, without defining the risk.
Exactly. The idea is investors demand more return for holding higher yielding currencies because those currencies carry some kind of economic or political risk that isn't fully captured just by looking at the current interest rate differential. The premium compensates for something unspecified.
Okay, not super satisfying. What else?
Central bank policies are a huge factor. What central banks do, what they say, even what the market thinks they might do in the future, especially banks like the Bank of Japan that kept rates super low for policy reasons for so long that massively influences currency flows in ways that aren't just about current rates or standard risks. Traders are constantly trying to anticipate or react to central bank moves.
Makes sense. And are there structural things within the system itself?
Definitely. Institutional factors. Think about huge global banks, hedge funds, asset managers. They have specific investment mandates, regulatory constraints, client needs. These things drive enormous currency flows that might persist regardless of the pure carry incentive. Portfolio balancing, hedging needs, that sort of thing.
What about psychology, human behavior?
Yep, behavioral factors. Ideas from behavioral finance seem relevant here. Things like investor herding everyone piling into the same trade, or maybe overreacting to news, could create biases in currency flows that last for a while. This might help explain that forward bias we talked about. The source even mentions a 2024 study suggesting the forward bias is mainly there when interest rate differentials are positive. That implies it might be tied to specific market moods or regimes.
Interesting. And the plumbing of the market itself, how trades actually happen.
Right. Market microstructures, the nitty-gritty of how orders are matched, market depth, how quickly information gets into prices. These mechanics can create small but persistent patterns in supply and demand that maybe contribute to the premium.
And bigger picture, long-term economic forces.
That gets attributed to global imbalances. Think long-running trade deficits or surpluses, or large, sustained flows of investment capital between countries. These can create steady pressure on certain currencies over long periods, influencing the carry trade dynamics beyond just the daily interest rates. Okay, lots of potential contributing factors. And the sources also highlighted a specific link between carry trades and market crises.
Yes, this is really key and helps explain at least some of the premium. Researchers find that periods when the usual positive interest rate difference actually reverses, so the normally higher rate currency suddenly has a lower rate, these periods tend to line up very strongly with broad market crises.
Like 2008.
Exactly. What happens is a flight to security. Investors panic, they dump risky assets, including higher-yielding currencies, and they rush into perceived safe havens, which is often the low-yielding funding currencies like the yen or Swiss franc. This sudden reversal causes the forward bias to flip dramatically, leading to huge, rapid losses for carry traders. So part of the premium might be compensation for bearing the risk of these sharp, painful reversals that hit precisely when everything else is going wrong.
And talking about sudden shifts, the NBER research really emphasized that these changes aren't gradual.
That's a critical point they make. The switch between good times for carry trades, positive differentials, favorable forward bias, and bad times, shrinking or reverse differentials, unfavorable bias, isn't smooth. The paper says snap shifts are the rule, not the exception.
Wow. So it just flips suddenly.
Yeah, it underscores the abrupt, almost discontinuous nature of carry trade profitability and losses. Makes risk management incredibly difficult. You don't necessarily get a gentle warning.
That abruptness really brings the risks into sharp focus. The sources are very direct about the dangers here.
Oh, absolutely. No sugarcoating. That Investopedia source plainly states the carry trade is best suited for sophisticated individual or institutional investors with deep pockets and a high tolerance for risk. It's definitely not presented as a strategy for the faint of heart or the undercapitalized. The potential for big, fast losses is just part of the deal.
Let's break down those specific risks the sources lay out. What's universally agreed upon is a number one danger.
Without a doubt, exchange rate risk. You can be diligently collecting that small interest rate differential day by day, but if the currency you borrowed suddenly strengthens sharply against the currency you invested in, it can wipe out all your gains and inflict major losses very quickly. Think about borrowing yen to buy dollars. If the yen unexpectedly surges, the cost of buying back those yen to repay your loan can skyrocket, easily overwhelming whatever interest you earned. It's the dominant risk.
So the currency move itself is the real potential killer, far more than the interest rate part.
Absolutely. The yield spread is often pennies. The exchange rate move can be dollars, metaphorically speaking. Now, interest rate changes themselves are also a key risk. If the central bank in your low-rate funding country decides to raise rates unexpectedly, or the bank in your high-rate target country cuts rates, that profit margin, the differential, shrinks or could even disappear. That makes the trade less attractive and can force an unwind.
And we saw that play out very dramatically just recently, didn't we, with the Bank of Japan?
We certainly did. August 2024 was a perfect real-world stress test. The Bank of Japan, facing inflation, finally started to meaningfully move away from its extreme easing policy. They raised rates slightly, reduced bond buying. This struck at the very heart of the massive long-standing yen carry trade, which was predicated on those near-zero Japanese rates.
And the market reaction was immediate, right?
Swift and brutal. As the yen started to strengthen on the news and the anticipation of more tightening, investors who were short yen who had borrowed it scrambled to cover their positions. This unwinding triggered massive volatility globally. Japan's Nikkei stock index crashed 12% in a single day, huge move. And here in the US, the S&P 500 dropped 3% that same day, August 5th, its biggest fall in nearly 2 years.
It's incredible how interconnected it is. A policy tweak in Tokyo sends the U.S. stock market down 3%.
It shows just how large and crowded these trades can become. When the dam breaks, the flood affects everyone downstream. Analysts at the time, cited in the sources, thought the unwind was maybe only half to 60% done, raising fears of more turmoil. Things did calm down a bit after, but it was a stark reminder of the systemic risk. The sources even note Fed Chair Powell hinted at a possible U.S. rate cut later that month, maybe partly to soothe markets rattled by the yen carry unwind. Central banks definitely watch this stuff closely.
Okay, so exchange rate risk is number one, interest rate risk is number two. What else do the sources warn about?
Market sentiment shifts, especially when a trade gets crowded like the yen carry was. If something spooks the market and everyone tries to exit the same trade at the same time, it creates a stampede. Selling pressure reinforces falling prices. Buying pressure reinforces rising prices for the funding currency, making losses worse for those still trying to get out. It's that classic rush for the exit.
What about devaluation risk?
Less common these days for major currencies, but still a risk, especially with emerging market targets. A sudden, sharp devaluation by a central bank, or maybe due to hyperinflation or political chaos, can just obliterate the value of your investment currency.
And just general economic instability.
Yeah, things like increased volatility in local stock markets or sudden large capital outflows from a country can spill over and cause currency chaos. And then there are economic shocks, the totally unexpected events, geopolitical crises, natural disasters, another financial meltdown somewhere. These can cause huge, instant currency swings before anyone can react.
So it boils down to this. The basic idea is interest rates. But the real danger comes from unpredictable market moves, especially exchange rates, and how these massive crowded trades behave under pressure.
That's it exactly. The yield is the slow, steady potential gain. The volatility, especially during these unwinds, is the sudden, sharp potential pain.
Let's shift now to dig a bit deeper into what that NBER academic paper tells us specifically about the nature of these risks. Because it sounds like some of their findings are a bit surprising, maybe even challenge the standard story, especially regarding the dollar.
Right. This is where it gets really interesting and nuanced. The paper doesn't just look at the carry trade. It examines different ways of constructing it, like equal-weighted EQ baskets, spread-weighted SPD, which gives more weight to bigger rate differentials, and even more complex versions trying to manage risk, RR for risk rebalanced, or optimize returns, OPT. They analyze the statistical properties of these different strategies, and one common finding often cited about standard carry trades like EQ and SPD is that they tend to show negative skewness.
Okay, let's unpack negative skewness for everyone. What does that mean practically for an investor holding that strategy?
Think of the pattern of returns. Negative skewness means you tend to get lots of small, frequent positive returns, kind of grinding out small gains most of the time. But occasionally you get hit with rare, very large negative returns, big losses. The distribution of returns isn't symmetrical like a bell curve. It has a long tail stretching out on the negative side. For carry trades, this seems to fit the story. Earn the small interest differential daily, but face occasional massive losses when things unwind violently.
So the conventional wisdom is basically that the carry trade premium, the positive average return, is just your payment for accepting that nasty downside skewness, that risk of crashing.
That's the standard explanation you often hear, yes. You get paid, on average, because you're exposed to those infrequent but severe losses, especially during market crises. Now, the NBER paper looks at this, but it also goes a step further and tests whether this premium can be explained by exposure to standard, well-understood market risk factors, things like the overall stock market return, equity factor, changes in interest rates, bond factors, or general currency market movements, FX factors.
And what did they find when they ran those tests? Do these standard risks explain the carry trade returns?
Well, they confirm there is some correlation. For example, carry trades involving the USD do show significant links to bond market factors, meaning their returns are influenced by shifts in the US yield curve, which makes sense. But here's the key finding. While there's some correlation, these standard factors often fail to fully explain the average returns, the alphas, of the carry trade strategies they tested.
Let's pause there. Alpha. What does that mean here, and why is it a big deal if standard factors don't explain it?
Okay, think of the factor loading as answering. How much does my carry strategy tend to move when the stock market moves, or when bond yields change? That's the exposure to known risks. Alpha is the leftover return after you account for all those predictable movements based on standard factors. If a strategy consistently generates a positive alpha that's statistically significant, it suggests there's something else driving its returns. It could be a persistent market inefficiency, or it could be compensation for some risk factor that we haven't properly identified or measured yet.
So the NBER paper found that even after you strip out the part of the return explained by movements in stocks, bonds, and general FX markets, there was still a positive average return left over for many carry strategies.
That's what they found, yes. The premium wasn't fully accounted for by these standard risk exposures.
Yeah.
And this is where the results for the US dollar specifically get really intriguing and, frankly, challenge that conventional wisdom about crash risk.
Okay, tell us about the EQ-USD strategy results, the one focus on the dollar versus other G10 currencies.
This was a standout finding in their analysis. The research shows that this EQ-USD strategy positioning, based on the US rate relative to the median G10 rate, generated a large and statistically significant abnormal return. That's a big positive alpha. And this alpha remains significant even when they controlled for a whole battery of standard risk factors. Equity market risk, bond market risk, general FX risk, even a volatility risk factor.
So the premium for this specific dollar-based carry strategy seems really robust. It's not just explained away by saying it moves with stocks or bonds.
Correct. But here's the kicker, the part that really goes against the grain regarding the standard crash risk story. The paper reports that the skewness for this specific EQ-USD strategy was statistically insignificant.
Insignificant skewness, meaning it didn't show that strong pattern of lots of small gains and rare huge losses. That's supposed to be the main justification for the carry premium.
Exactly. While other carry strategies might fit that negative skewness profile, this particular dollar-centric strategy, according to their analysis, surprisingly did not show statistically significant evidence of it. This directly challenges the simple explanation that the EQ-USD premium is just payment for taking on obvious crash risk or negative skewness. It strongly suggests something else, something perhaps specific to the dollar's role, might be driving that persistent alpha.
That's fascinating. It leads right into another part of the paper where they directly tested some specific downside risk explanations. They looked at models, like from Lettow, Maggiore, and Weber, that argue returns are explained by how assets perform specifically when the overall market is doing badly. What did the NBER paper find when applying those models to carry trades?
Their findings here were also quite striking. For the G10 carry trades they examined, the paper found insignificant exposure to those specific downside market risk factors proposed by Lettow and others. Their conclusion was pretty blunt. Based on their tests, these specific downside market risk models cannot explain the average returns they observe for these G10 carry strategies.
So according to this research, the premium isn't simply because carry trades tend to lose money particularly hard when the whole stock market tanks. That common narrative doesn't seem to hold up in their tests.
That's what their results suggest for these G10 strategies, yes. It implies that whatever risk is being compensated in the carry trade, it's not straightforward exposure to broad market crashes, at least not in the way those particular models capture it.
They also looked at something called the Downside Risk Index, or DRI, which is based on the pricing of S&P 500, put options a more direct measure of market crash risk perception. How did carry trades relate to that?
This added another layer of complexity. They found that if you looked at the DRI by itself, it could statistically explain the average returns of the standard EQ and SPD carry strategies. It looked like, okay, maybe they're just being paid for crash risk as measured by options prices. However, when they put the DRI into the model alongside standard equity market factors like the overall market return, the DRI's explanatory power disappeared. Its loading became statistically insignificant, and crucially, the unexplained alpha remained large and significant.
Okay, let me try to wrap my head around that. The DRI alone seems correlated, but when you account for normal stock market movements, the DRI doesn't add any extra explanation, and the mysterious alpha is still there. What does that imply?
It suggests the DRI might be correlated with the conditions where carry trades do poorly, but it might not be the independent causal risk factor itself. Think of it like seeing lots of umbrellas when it's raining. Umbrellas are highly correlated with rain, but they don't cause the rain. The NBER paper's finding here suggests the DRI might be acting a bit like the umbrellas it shows up when carry trades get hit, often during market turmoil. But it might not be the fundamental driver of the premium once you account for general market exposure. It complicates the simple paid-for-crash risk story significantly.
Definitely adds nuance. What about strategies that try to hedge some of this risk, maybe using options? Did the paper look at that?
Briefly, yes. They examined hedged carry trades using options. As you'd expect, buying protection with options does reduce the maximum potential loss. It chops off that nasty left tail to some extent. But naturally, there's no free lunch. Hedging costs money. The research showed that these hedge strategies had lower average returns. And in the shorter time period they had data for hedge strategies, the statistical significance of those returns also decreased. Plus, the way these hedge strategies reacted to the standard risk factors also changed. So hedging is a trade-off. Less extreme downside, but also lower average profits and a potentially different risk profile remaining.
Okay. Finally, the paper really zooms in on the actual lived experience of losses, the drawdowns, the peak to trough declines. What did they find there?
This is really about the practical reality for anyone running these strategies. They look at drawdowns, any drop from a previous high point, and also pure drawdowns, which are strings of consecutive losing periods. They document the worst historical drawdowns. For instance, the standard EQ strategy had a worst drawdown of 12% over about 3 months. The SPD strategy, which weights bigger differentials more heavily, had an even worse drawdown, 21.5% loss over about 5-6 months.
Those are definitely serious hits, painful periods.
Absolutely. But the really insightful part of their drawdown analysis wasn't just the single worst episode. It was comparing the frequency of less extreme but still quite severe drawdowns in the actual historical data versus what simple statistical models would predict. They used simulations based on assuming returns are random and independent over time, like flipping a coin each day.
And how did reality compare to those simple models?
It showed that for these less extreme but still painful drawdowns, say multi-percent losses over a few weeks or months, strategies like the EQ carry trade actually experience them more frequently in the real world than the simple random models would suggest. This implies the real-world drawdowns are fatter-tailed or more clustered than you'd expect from pure chance. The bad times aren't just random. They seem to happen more often or stick together more than idealized models predict.
So it's not just that a big loss can happen, it's that significant losing streaks or periods seem to occur more often in reality than basic probability might suggest. The market dynamics make these bad runs more likely.
That's the implication. They found a similar pattern for the pure drawdowns, consecutive losing days, too. The frequency of hitting certain negative streaks was higher in the actual data than in the simulations. It paints a picture of carry trade risk involving these clusters of losses that aren't well captured by simple assumptions of randomness.
Okay. Wow. We have covered a lot of ground here, from the simple idea to some pretty complex and counterintuitive research findings. If we try to synthesize all of this, what are the absolute key takeaways about the carry trade, its premium, and its risks, especially keeping in mind these nuances?
Okay, let's try to pull it together. First, it's clear the carry trade is way more complex than just borrow low, invest high. How it's done forwards, leverage, and the fact that profits seem to hinge on exploiting those deviations from theory, the forward bias, is fundamental.
And the US dollar's role is flexible, not fixed. It can be funding or target, and specific strategies focusing on the dollar, like that EQUSD, seem to have interesting properties, according to this research.
Right, and that leads to the second key point from the NBER paper. Those properties challenge the simple risk story. Specifically, the finding that the EQUSD strategy showed a significant alpha without significant negative skewness, and without being fully explained by standard risk factors or even some specific downside risk models. That's a major finding that keeps the debate about what risk is being priced very much alive.
But even with that puzzle about why the premium exists, the risks themselves are undeniably real, potent, and potentially systemic. The unwinding events, like 2008 and the sharp moves in August 2024, are brutal reminders of that.
Absolutely. Those events show how quickly things can unravel, how contagion spreads, and how interconnected global markets are through these trades. The risk of sudden, severe drawdowns is not theoretical. It's a documented historical fact, and perhaps happens more often than simple models suggest.
So the picture is, it seems to work on average over the long haul, generating a premium. But why it works isn't fully settled, and the potential for sudden, sharp, clustered losses is very real. The research adds layers, suggesting the risk profile might be more complex than just simple crash risk, particularly for dollar strategies, but the danger of abrupt reversals and significant drawdowns remains a core feature.
But that sums it up pretty well, I think.
This has definitely been a deep dive. We've looked at how the carry trade tries to profit from interest rate differentials, how leverage and forwards are key tools, the flexible role of the US dollar, and the very significant risks, especially exchange rate volatility, and those sudden unwinding events like '08 and '24.
And we've layered on top those fascinating, sometimes challenging findings from academic research, the persistent premium, the questions around standard risk factors and skewness, especially for dollar strategies, and the evidence that severe drawdowns might be more frequent than simple models assume.
The bottom line from all the sources is pretty consistent, though. This is a sophisticated game with substantial risks. It's for players with deep pockets, sophisticated analysis, and a strong stomach for potential volatility and losses.
The potential rewards seem tied to exploiting market structures and maybe mispricings, but they come hand in hand with the potential for rapid, significant downside.
Which leaves us, and you listening, with a final thought to chew on. If that research is right, and specific dollar carry strategies offer a persistent premium without the usual hallmarks of crash risk or strong ties to standard downside factors, what exactly is that premium paying for?
Is it some unique, maybe poorly understood risk linked to the dollar's central role in the global financial system? Or is it just evidence of a persistent market inefficiency that smart money can exploit?
At least until the music stops and the next sudden painful unwinding hits. And thinking about that August 2024 event, its speed, its global reach, what does that tell us about just how interconnected and perhaps fragile our modern, highly leveraged financial markets really are?